Hello and welcome to Stockwatch Live. There's a smattering of results out this week, so what's of note? Well, to start with, on Tuesday we'll get an update on the shape of the UK house building sector when Persimmon posts half-year results. Back in April it said forward sales so far in 2018 were up by about 8% year on year, while pricing conditions remained firm across regional markets. Investors will want to hear how forward sales are going. In April, private sales were up by the same period the year before, and so too were new homes for its housing association partners, so we'll have to see whether that has continued. Citigroup is neutral on the shares and has cut its price target from £28.60 to £25.75. Broker Berenberg has initiated coverage with a hold rating and set a price target of £27.60. Shareholders in mining stock BHP Billiton, hoping for some more positive news, may be left digging in the dirt. Hot on the heels of an announcement that it has reached a $50 million settlement with a group of shareholders concerning the Samarco dam failure in Brazil in 2015, came news that it was reviewing contingency plans ahead of a possible strike by Chilean workers at Escondida. This is the world's largest copper mine, and last year a 44-day strike at Escondida, which accounts for around 5% of global copper supply, hit the metal market and also Chile's economy. This week, BHP shares were headed for their lowest level to date after a dollar rally piled the pressure on metals prices, which have already fallen on fears of the knock-on effects of the Turkish currency crisis. News that BHP has reached a deal to avert a strike at Escondida will be welcomed at a time when copper producers have more than enough to worry about already. Take a look at its share price over the past 2 weeks alone. Jefferies International rates the shares a hold, but has raised its price target by 50p to £15.50. Liberian Capital, though, says they're a sell, although it has raised its price target significantly from 800p to £13. UK-listed gambling software provider Playtech has had a tough time so far, issuing not one but 2 profit warnings in a year. The latest warning, surrounds Playtech's expectation that increased competition in China will cut expected Asian revenues by half this year. Group profits could be flat at €320 million. If this sounds familiar, that's because it is. Last November it issued a similar warning about a gambling crackdown in Malaysia. The latest warning just shows how much of a gamble the Asian market is for Playtech, and the added peril of operating in unregulated markets. But of course, where there's risk, there's also potential reward, and it's hard to ignore the fact that Asia accounted for about 1/3 of group revenue last year. But 2 profit warnings highlight the peril of operating in unregulated markets. However, its Asian operations have been trimmed down, and the purchase of Italian gaming company Snaitech in April seems a wise move. Its revenue last year was €885 million, and with cash in the bank there is scope for Playtech to make further acquisitions and shift its business model so it isn't as heavily reliant on Asia. While the company is being brutally honest about the challenges it faces, it seems brokers following the stock still largely support it, although they have taken a knife to their price targets. In the days after the warning, Numis reiterated its buy rating but cut its price target to 882p from £11.25. Deutsche Bank also says the shares are a buy, but it has cut its price target from £13 to 940p, while more recently Barclays Capital has said it has an equal rate investment rating on Playtech but cut its price target from 806 to 575p. The one real fly in the ointment is Credit Suisse, whose downgrade from outperform to neutral sent the shares almost 4.5% lower. In a note it said, "We think a cost-saving programme announcement is likely, but that the risk of further attrition